That perfect chart pattern you spotted? Your brain may have invented it out of pure randomness. There was no signal. There was no setup. There was just noise, and a mind desperate to make sense of it. This isn't a flaw you can think your way out of. It's baked into the oldest, most powerful part of how your brain works. And in the markets, it quietly destroys accounts. The name for it is apophenia. The tendency to perceive meaningful connections between unrelated things. To see faces in clouds, hear messages in static, and find perfect trend lines in prices that are moving completely at random. Your ancestors survived because of this. Imagine two early humans hearing rustling in the grass. One assumes it's the wind. The other assumes it's a predator and runs. If it's just wind, the runner wastes a little energy. But if it's a lion, the one who assumed wind is dead. Over millions of years, evolution favored the brain that saw a pattern even when there wasn't one. Seeing a false pattern was cheap. Missing a real one was fatal. So your brain became a machine tuned to overdetect, to connect dots that were never connected. That instinct kept your species alive on the savannah. But drop that same brain in front of a price chart, and it becomes a liability. Because the market doesn't reward you for seeing lions that aren't there. Here's where it gets uncomfortable. Randomness does not look random. That's the trap. Truly random data is full of streaks, clusters, and shapes that look intentional. Statisticians call this the clustering illusion. If you flip a coin 100 times, you'll get long runs of heads, sudden clusters, and stretches that feel rigged. But it's pure chance. People shown truly random sequences reject them as fake. They think random should be evenly spread out. So when they try to fake randomness themselves, they make it too smooth, and a computer spots the human every time. Now think about what a price chart actually is. Thousands of buyers and sellers, news, emotion, and noise, all colliding. Large chunks of that movement are, statistically, indistinguishable from random walk. And your brain, that ancient pattern machine, stares at this noise and does exactly what it evolved to do. It finds the head and shoulders. The double bottom. The perfect descending triangle. Researchers have proven this in a brutal way. They generate charts from completely random data, no real market involved, and show them to traders. The traders confidently draw trend lines, spot support and resistance, and call out textbook setups. On charts of nothing. On charts with zero underlying edge. The patterns felt real because the brain built them, not because the market put them there. This is why two skilled traders can look at the same chart and see opposite setups. One sees a breakout, the other sees a reversal. They're not analyzing the market. They're projecting their own expectations onto noise. And it gets worse, because another bias locks the illusion in place. It's called confirmation bias. Once your brain decides a pattern is there, it starts hunting only for evidence that agrees. You'll notice the 3 times that pattern worked and quietly forget the 7 times it failed. Your memory becomes a highlight reel that proves you were right, even when you weren't. So now you have a false pattern, reinforced by selective memory, wrapped in total confidence. That combination is expensive. You size up on a setup that has no statistical edge, and you call the loss bad luck. Here's the deeper problem. Even a coin flip strategy will produce winning streaks. Random entries can go on a hot run for weeks. So the illusion pays you sometimes, and that random reward is the most addictive teacher of all. Intermittent, unpredictable rewards create the strongest habits known to psychology. It's the exact mechanism behind gambling. When a random pattern occasionally wins, your brain bonds to it harder than if it won every time. So how do you fight a bias that's older than language itself? You can't delete it. But you can build systems that don't rely on your eyes trusting your brain. First, demand evidence beyond the picture. A pattern that looks perfect means nothing until it's been tested across hundreds of occurrences. If you can't measure how often it actually works, you're trading a hallucination. Second, keep a written record before you enter, not after. Write down exactly why you're taking the trade and what would prove you wrong. This drags the pattern out of your imagination and into cold, checkable reality. Third, actively count your losses. Force yourself to review the setups that failed with the same attention you give the wins. Your brain won't do this on its own. It's built to forget the misses. Fourth, get comfortable with the phrase, "This might just be noise." The most dangerous words in trading are, "I can clearly see it." Certainty is often the symptom, not the strength. Because the real skill isn't spotting more patterns. Anyone can do that. Your brain does it automatically, endlessly, for free. The real skill is knowing which patterns survive testing, and ignoring the thousands that don't. The market is not a puzzle waiting to reveal a hidden picture. A huge part of it is genuinely random, and randomness will always tempt you with shapes that mean nothing. So the next time a setup feels too clean, too obvious, too perfect, pause. Ask whether the market drew that pattern, or whether the oldest software in your head drew it for you. Because your edge doesn't come from seeing more. It comes from doubting what you see, and testing it before you risk a single dollar on it.